Welcome back to another episode of Boss Economics World. Now, buckle up, because today we're diving into the US economy and its current state of affairs, a roller coaster of growth, flashy consumer spending, soaring defense budgets, and, of course, the ever-intriguing political landscape. But behind all that glitter, are things really as strong as they seem? What's going on? America's GDP numbers are looking at a flattering 2.8%, and while it seems like it's all sunshine and roses, we need to cut through the noise to uncover what this means for regular people, and whether this delicate balancing act can hold up much longer. Now, let's not waste any time and get straight into the meat of it. So, what's the situation? The US economy grew at a 2.8% annual rate in Q3. Oh yes, we've seen worse. In fact, compared to the growth struggles of the pandemic years, this seems like a kind of miracle, am I right? It should be a great victory lap for Joe Biden and Kamala Harris, as they gear up for that final stretch before the election. But let's be real here, 2.8% is respectable, yet under the hood, the situation is much more nuanced. If we break it down, much of this growth spurt is being driven by consumer spending, and let's not forget, government spending has gone ballistic thanks to defense. Now, why is this important for regular citizens and businesses? It's because consumer spending happens to be the biggest engine of the US economy, accounting for about 70% of economic output. And herein lies the rub. While consumer spending climbed 3.7%, sounds fantastic, right? Much of this growth was powered by purchases of autos, home furnishings, and recreation items. But why the rush? Well, voters are feeling the pressure of high inflation, and they're spending not because they feel optimism, but out of an urgency to secure goods before things get pricier. There's more to it. If you follow the retail landscape closely, you'll see that many big retailers boosted imports ahead of Q3 due to dockworker strikes threatening supply chains. Hence, the timing of the purchases makes the growth headline seem a lot more glorious than it actually is. What happens when growth is driven especially by stockpiling and short-term anxieties while structural economic issues remain unaddressed? It's a short-term tailwind that could lead to a long-term storm. Now here's another fascinating layer to peel back. US government spending jumped 5%, but here's the kicker, defense spending shot up 14.9%. That's the biggest spike since the Iraq War days of 2003. Wait, 2023 was supposed to be the year of healing post-COVID, not rearming. What's going on? Why is defense spending skyrocketing? Well, it's not just to revitalize the US armed forces, but it also conveniently pumps billions into industries that support jobs, tech innovation, and contractors. But while that might give the quarterly GDP a steroid boost, we must ask ourselves, is spending this kind of money on military hardware sustainable or wise in the long run? Defense spending often benefits a select few corporations, which grab lucrative contracts while the everyday person gets stuck dealing with stagnant wages after inflation. Remember, inflation-adjusted personal income grew just 1.6%, the smallest gain in over a year. So, while Lockheed Martin and Northrop Grumman shareholders get rich, are ordinary Americans really sharing in that record growth? Remember what happened in 2008 when everyone was focused on short-term spikes in spending while neglecting deeper financial cracks? That led to the financial crisis. Does anyone else feel déjà vu? You heard it here first, inflation-adjusted spending is still rising, and, according to the Fed's favorite yardstick of inflation, it's staying reasonably balanced at 2.2%. For the casual observer, this sounds like the Fed's got inflation under control, right? Not so fast. If you look closer at the data, you see that much of the price stability comes from energy and food prices somewhat cooling off compared to their meteoric rise after Russia's invasion of Ukraine. However, core inflation figures show some very different stories, particularly in services, housing, and care, still running painfully high. Yes, the Fed has had a heck of a run taming inflation. But how? By slashing rates aggressively, they're basically punching the economy in the face to get inflation to back down, which leaves interest rates so high that it's suffocating sectors like housing. Speaking of housing, did you guys catch this? Housing investment shrunk 5.1% this quarter. You thought the Fed was cooling rates so the housing market could settle itself and breathe fresh air? Think again. The high mortgage rates, which are now above 8%, are weighing so heavily that no one can afford to buy homes. And this is clearly not making the average worker any richer. If anything, this is pushing large swathes of the middle class into the rental abyss. If you're a young professional struggling to scrape up a down payment, your American dream of homeownership is increasingly becoming just that, a dream. And who's pocketing the profits amidst this? Institutional investors scooping up homes for rental properties. Profits and wages. That's the hidden dynamic every economist worth their salt must address. Every time the GDP grows and profits balloon, Wall Street backpats itself for another grand quarter. But hold up, most of that growth is not going to wages and worker incomes. Here's the real underlying heartache. While corporate profitability has remained far above historical norms, lifting the profits to GDP ratio to extreme levels, inflation-adjusted incomes just inched forward. Those fed up with pay that's barely keeping up with inflation might rightly ask, where is all this record growth vanishing to? The economic reality for millions of Americans is more about stretching their paycheck thin than feeling like participants in a booming economy. It's clear that trickle-down economics isn't trickling at all. Taxes still favor corporations and the rich, leaving middle-class Americans under a heavier burden. Remember that seemingly innocent 1.6% increase in inflation-adjusted personal income? That number is essentially a flailing life raft for workers swimming against a tidal wave of rising everyday costs. Now, we can't talk about this quarter's economic numbers without addressing the giant elephant in the room, artificial intelligence. Oh yes, the numbers sing AI's praises. Investment in computers and peripheral equipment skyrocketed by an unbelievable 32.7%. It seems like everyone is jumping on the AI bandwagon. But let's get real, all this hype about how AI is revolutionizing industry feels eerily like the dot-com bubble of the late 1990s. Why? AI-driven innovation is driving up stock values, yes. But for whom? For many companies, AI investment at this stage is still speculative at best. A lot of capital is being poured into this trend without clear paths for sustaining long-term profits, leaving everyone betting huge profits on tomorrow when today's cash flows don't yet justify such optimism. Moreover, for the everyday worker, AI is more of a threat than a boon. Jobs that can be automated are likely to evaporate, and that's where we see another seismic shift. The economy might be humming along with AI-driven productivity, but how many workers will be displaced once AI gets fully implemented? Is it really building something stronger, or have we poured gasoline on the next tech bubble? So, let's zoom back to the political backdrop. Biden's administration will be celebrating these outstanding quarterly stats. After all, the 2.8% GDP growth is a talking point to rally on in the election against Trump. The official narrative will likely be, look, we've built a strong foundation, jobs are back, wages are growing, even marginally, and businesses are thriving. But the people feeling the pinch of high home prices, sluggish wage growth, and uncertainty about the future know better. Regular voters are dealing with inflation at the gas pump, higher interest rates on loans, unattainable homes, and ever-growing disparities between rich and poor. The GDP growth is optics, plain and simple. It hides a widening chasm beneath the economic surface. Don't be fooled by the shiny GDP numbers or the biggest surge in defense since 2003, it's the long-term problems that matter. The 1% are thriving, but is everyone else? In conclusion, the surface-level numbers may portray a robust, growing economy, but dig deeper, and you see the cracks emerging. The structural issues are still unresolved: slowing wage growth, unequal distribution of wealth, massive government spending on defense rather than public goods, and housing mortgaging the future of young Americans. Behind the seeming momentum of the U.S. economy lies a fragile, fragmented landscape. Don't be fooled by GDP, this isn't economic stability. This is a big, illusionary financial circus that risks fueling another bubble. Stay aware. Stay skeptical. And most importantly, keep questioning the so-called numbers that don't tell the whole story of where we're headed next. Thanks for tuning in, and until next time on Boss Economics World. Let's start asking the hard questions, because nobody else is.